Guys, make sure you have something like where you can note down, because what I'm gonna talk about is something that I would never want to talk about ever again. Okay, can someone just confirm with the Y that you can see my screen as well as?
Yes, Kabir can hear you, sir.
Great. What's up, guys? This is your Louis from Nice Speed speaking. As usual, let's hide this. Right. Guys, please mute your devices. Please mute your devices. All devices on mute. Thank you. Let's have all devices on mute, please. Let's have all devices on mute, please. Thank you. Now, great. So I was going through like TradingView. Like I was having class with just another student just now, and I saw like, I was like, wow, okay, so I have a YouTube channel, I have a free channel, and I just felt like, no, I should like return back to the people, just as good as paying tax, right? You can consider this like paying tax or returning back to the society, paying back to the soil that we step on. Now, I want to show you something, something pretty simple, pretty cool, something that I normally look at when I'm analyzing, something that I teach to my VIP students. If you ask them, they will tell you that this makes part of what we learn daily. This makes part of what we do or what we study in the VIP channel daily. I'm going to take a little more time while I do the setup. Great. Now, the first thing I want you to know, or the first thing from the basics of Forex, is the structure. I'm sure if you ever done like Forex starters, Forex for beginners, anyway, I don't know where you started hearing the word Forex, wherever. Normally I teach using like Forex Space, then we take the information and we apply it like to volatilities, right? Because on Forex Space, that's where we have like a lot of stuff happening. The structure, how is the structure? First of all, I'm just going to talk about basic movements, right? I'm talking about like when price drops drastically like this, which is what we refer to as an impulse movement. This is what we refer to as an impulse movement. Guys, writing with a mouse is never cool, right? When price drops drastically like this is what we refer to as impulse movement. Normally, when this happens, this is as good as price moved in a straight line. This is as good as price moved in a straight line. And price is not or is never supposed to move in a straight line. So because price did what it's never supposed to do, it is going to correct these measures by giving what we call a corrective movement, which is what we call correction, right? So this is what we refer to as correction, right? So we have an impulse movement, we have correction. You see a drastic movement, and we have what? Correction. We have a drastic movement, and we have what? Correction. We have a drastic movement, and we have correction until a certain level of a break of structure. I'm going to get to this point here. Just be a little bit patient. I'm going to get to what I personally refer to as a break in market structure. Right now, I'm talking about these movements right here. You see an impulse movement, and we have this correction. We have this impulse movement, we have correction. We have this impulse movement, we have correction. We have this impulse movement, and we have correction. I'm going to give technical reasons why price is supposed to impulse, then correct. Then I'm also going to give like market maker reasons why price is supposed to like impulse, then correct, then impulse, then correct. Initially, technically speaking, by technically speaking, I'm talking about those basic average or overall Forex classes that you get on Baby Peeps, that you get on free YouTube platforms, that you get from other channels I won't name, that you get from anywhere else, right? You know the concept of flags, right? Or the concept of triangles in price. We all use this, like this is where we all come from, like we all evolve from this style of market analysis. This is believed to be the reason why price cannot move in a straight line. Why? Because retail traders want to believe that it has to be forming patterns to allow entry triggers. Right, it has to be allowing patterns. So in this case, I have.
What is that?
This is
in this case
I have what? Please let's have all devices muted. Please let's have all devices muted for the sake of the recording and audition. Let's have all devices muted. Thank you. Now, if I look at this case, this impulse, then I have this correction right here. This is what is referred to as a bearish flag, right? A continuation pattern.
Oh, this is what is normal results that you see.
This is what is referred to as a bearish pattern, or I mean a bearish flag, which happens to be a continuation pattern. The same applies in this drop right here, and we have this type of correction. This is what we refer to as a descending triangle in this case, right? This is not a symmetrical triangle. This is a descending triangle on a short scale. Why? Because this is something like a 1 hour chart. So this is a short scale chart, right? Depending on what type of a trader are you. For me, 1 hour time frame is a very short time frame to trade because I'm a day trader and a position holder sometimes. Now, speaking on market maker grounds, these are the times in which you are supposed to take your note, because I don't say such things twice. If you look at this zone, let me annotate it using like a green patch. Make it yellow because yellow is close to white. Make it like this, and let me locate. Opa, excuse me. And let me lock it like this. Uh-oh. I don't understand why Trading View, when I look, it disappears. Look is this one, right? Yes. Now, we are just looking at this small portion of price in yellow. And I said that if we look at price movement, this is impulse, then this is what? Correction. Now, I'm going to show you something on market maker basis, right? On a market maker or on an institutional level or at a smart money level of how this is going to happen. First of all, we have what we refer to as price gaps. Some may call them fair value gaps. Some may call them price inefficiency. Some may call them price imbalances, right? Which is what I'm going to show you now. I know for a fact that after this video is going to be broadcasted on YouTube, is going to be deleted for copyright. Why? Because the terms that I used are the terms that I also learned from someone. The only difference between them and I is I can give such information for free, which is why in most cases I'm charged by YouTube for copywriting. So you make use of this information while it's still available on my platform, because anytime from now it's going to be deleted and I'm going to be charged, and I'm willing to go down for you guys. Now, let's continue. If price drops low, I'm talking about these 1, 2, 3 candles only. If price drops low, 1, 2, 3, there is this middle candle right here, which we refer to as the reference candle. Now, the gap between the left candle and the right candle is what we refer to as imbalances in price action. This is what we refer to, or this is what is referred to as imbalance in price action. And all of these points are points that price must come back to refill. You see, this middle small section in price, these are levels in which influenced the movement back, which is referred to as correction by retail traders. So let's look at the movement again. We have this drop downward, then we have what? Correction, right? Like this. Now, if we look at retail grounds, this is actually making sense. This is what we refer to as a bearish flag. But if we look at an institutional levels, the price makers, the market makers, they actually came back to grab what we refer to as liquidity that is within this imbalance. They came back to fill the balance right here, to balance price, because they should be balanced between buyers and sellers in the market. So we are talking about the middle candle, which is our reference point, and I was talking about the candle to the left and the candle to the right, and the distance between those two candles. That is what is referred to as the fair value gap, the imbalance in pricing, or an inefficiency gap. And in most cases, these gaps are supposed to be refilled, which implements balance between buyers and sellers. That's 100%, guys. This is 100% explanation of what I can give pertaining to this. If you didn't understand this, please rewatch this video. This video is going to be published on YouTube in case you need to rewatch. Another scenario of what I'm talking about, right? Another scenario of what I'm talking about. If we have this black candle right here, if we have this black candle right here, if I take the candle to its left, which happens to be this one in this case, and the candle to its right, which happens to be this one in this case, we have again an imbalance. So whenever we have such an imbalance in price, it means price at a certain point in price action is going to come back to refill that specific zone. Why does it have to come back and refill? So that it can balance equilibrium between buyers and sellers. That is why it is called price imbalance. If you have any questions, please feel comfortable to leave them in the chat. There is a chat. Those who are using Zoom, those who are using YouTube, I don't know how you can do it, but there is chat also on YouTube. You can leave like questions right there and we'll come back to revisit them. So this is what we call imbalance. And if you can look at price action, just this zone, I'm going to specify specific, I'm going to specify this zone actually, and this one. And look at how price reacted when it got to that zone. Look at how price reacted when it got to that specific zone, which is pretty cool stuff, which is kind of like cool stuff to me. Why price had to like get to this point and call downside movement or trade it lower. If you also look at this specific zone, which I showed you at first, I'm talking about this level of price and this level of price. You see how price actually reacted when it got to that specific price range. Guys, I do not believe in things like strategy for NASDAQ, strategy for boom and crash, strategy for ABC, strategy for volatility. What I trade is based on the market structure, its price analysis, its price movement, and the information that I'm giving you. You can go check it on any price chart that you want, be it Bitcoin, be it Tesla shares, be it volatility indices, which are my personal favorite, be it like these Paridadish, or how do you call them in English? Forex pairs, right? You go check it, depends on what you like. So these are the first initial two reasons why price cannot move in a straight line. Because think about it. If price moved in a straight line, how will it balance, or how will it create what we call equilibrium between buyers and sellers? Because look at the marketplace. There should be balance between buyers and sellers. Like there should be sellers for the buyers and there should be buyers for all the sales that are implemented by the market, which gives back to the concept of supply and demand in the market, which is something that I wish one day I'll call out a Zoom call so that I can teach you guys how to do like supply and demand price analysis, which is pretty cool. Again, you could do, I've seen traders using only supply and demand for market analysis. Now, let's go back to looking into things, right? If I look at what I just showed you right now, if I look at this section in price, if I look at just this section in price, there are 100% reasons for you to be hunting for sales within this region. Well, I have people who trade the M and W, right? If you zoom out lower, I am 100% sure, though I'm not going to zoom out because of our time, and Zoom cannot like go longer. There is a perfect M setup right here. Talk of support and resistance traders, not necessarily the basic support and resistance, but I'm talking about like supply and demand, right? Those who trade like rally best rally or rally best drop. There is a perfect entry trigger for this right here. I'm going to show you like entry triggers to the upside chart. I'm avoiding like dropping down to a 15-minute, to a lower 3-minute or 1-minute time frame just to look at this, right? It's going to consume a lot of time in the zooming out. Now, let's look at another scenario, which happens to be this drop right here. If you look at it, this is another price imbalance, And sooner or later, I know for a fact that when price get to this specific zone, it's going to react somehow. Why? Because there was some kind of like imbalance between buyers and sellers. This is an implication of selling activities only. Where are the buyers for the sellers, which concludes the concept of supply and demand. Boom. This is what happens when price got again to that specific zone where it had to balance buyers and sellers. And look at it. Price actually came back to refill. So these specific zones could help you in 3 ways. 1, in this scenario, they could have helped you to trigger an entry. 2, in a buying scenario, right, they can help you. For example, if I look at this zone right here, which is an imbalance, and I'm holding a sell, which I would have taken right here, I can actually sell. And when I see it coming back, I know for a fact that price is only coming back to refill specific imbalance before it continues to drop. Why? Because I believe in a higher time frame flow. I won't start like analysis on a 1-hour time frame. Obviously, I'll start it on a weekly, on a monthly, on an H4 time frame. Right. So if an H4 time frame is telling me that price is going down and price start going up in a 15-minute time frame, I just have to look at factors why price might be going for such space or on such a direction. If you happen to have any questions, feel comfortable to leave them in the chat. There is chat for Zoom. I'll check on it. Let me finish like the explanation, then I'll check out the chat as soon as we are done. Right. Now, I'm not teaching people how to trade right now. I'm not teaching people how to take entries. As the topic says, I'm just showing you some of the things that some people don't want you guys to know because maybe you didn't join their paid groups or their paid forums. I don't know. I don't know how traders do it. Do we make money through paid forums or we actually make money through trading? But I'm showing you information that I wish you guys knew long time ago when you were 20. Excuse that. Now, if you had any selling position and price started going against it, but you were actually in some form of profit, there is no need for you to open a position based on analysis and you close it based on emotions. I'm sure that's a point that you should like write it down somewhere. It's important. You don't open an analysis based on, you don't open a trade or a position based on analysis and you close it based on emotions. Even holding should be technical. It's not should be technical. That's why I'm showing you this information concerning imbalance, right, in price action. If you look at this price range right here, if you look at this price range right here, I remember the days I used to like record courses or take screenshots so that I could like use to run classes, the 15 days things. This is a price scenario that some of them, if you attended, they could remember. There is nothing like insufficiency between this range right here. There is nothing like insufficiency between this range. Why? Because we have price trading in both sides. We have price trading in both sides. We have buy side, we have sell side to fill in insufficiency. We have buy side, we have sell side to fill insufficiency, but we have this level right here. I had not noticed that, pardon. Right, I had not done that. We have buy side, sell side, buy side, so there is no gap between anything. We have complete buy side and sell side with no voids, like, I mean, no imbalances. Then we have this small gap right here, which was quickly taken out, which was quickly grabbed, right? And price retraced lower, then pushed to the upside, right? But still we have this gap right here, which sooner or later in future, it's a gap that I am supposed to be paying attention to. Say, for example, I didn't say start selling Euro USD. If for any reasons you are in any selling position, if for any reason you are in any selling position, these are zones in which you can anticipate grab, right? Or in which you can anticipate that you can be looking at taking down your trades, or you can be looking at closing some position or collecting partials. I don't know how you trade. I don't know what your analysis is based on, but these are specific zones in which you can be like looking at collecting some profits. Why? Because price might come back to fill this specific imbalance so that it would balance the rule of supply and demand. Agreed, right? Yes, agreed. If you have any questions, please feel comfortable to leave them in the chat or in the forums, right? Those who are on YouTube, those who are on Zoom, doesn't matter. Now, the last thing that I want to show you guys, is what I like the most. What I showed you, if you attended the crowd fund, not the crowd fund actually, pardon, the crowd funds live, which we hosted last year, which is the anatomy of W's and M. I see traders looking at M's, looking at W's, and trading M's and W, whereby they believe that if price performs an M, we sell. If price performs a W, we buy, which is not wrong, right? Because it's a concept that comes from the issue of double top and double bottoms, which is actually a retail perfect pattern that is proved to be working for years and years, even before I was born. But the question is, why is it that this formed an M, but it didn't sell? Why is it formed an M, but it didn't sell? So what I want to show you is the difference between this M right here and this M right here. Is the difference between this M right here and this M right there. Now, let me quickly show you guys that before I close the day. I hope this information is going to be helpful. I was just browsing through my trading view and I just thought like, no, I think I should let people know about this kind of stuff. The perfect M, for the sake of the noise in my background, I'm going to thank you. Okay. For the sake of okay, the M, if you remember, if you attended the crowd fund, I personally said, I gave people the concept of order blocks. If you didn't watch order blocks, there is a video on YouTube on the lockdown videos, lockdown day 1, lockdown day 2, lockdown day 3. I'm sure it's lockdown day 1 or day 2, where it talks about order blocks, right? And it also talks about the order blocks that is finally broken. If not, let me quickly go down to it. If not, right, but I'm sure we spoke about it. We have this candle right here, this black candle right here, this black candle right here. It's a candle that happened before this movement to the upside, right? And it was broken down. Now, when that happens, this is what is referred to as the breaker. When that happens, this is what is referred to as the breaker. Normally, when we have the breaker, a breaker, first of all, what is a breaker? A breaker is a broken order block or the last order block in a cycle. You see, we have been having black candles, but none of them was broken down. We've been having black candles, but none of them was broken down. We're having black candles, but none of them was broken down until we have this specific one, which was actually broken down, right? When that happens, it means the structure is changing from being bullish and it's now turning to bearish. Why? It's just a structure confirming itself, right? Now, when we have that, if you look at right here on this M right here, we didn't have that, right? We didn't have that. Now, point number 2 is that when we have a breaker, the upward candle is the origin. The upward candle is what we refer to as the origin, which happens to be, in this case, this upward zone right here. This is what we refer to as the origin. The origin, the source, the beginning, you call it whatever you want. Now, this, why is it called the origin? Because this is where the new trend is now starting. If it has been going upside, then it broke the upside structure. It went back to retest the origin. The origin of what? The origin of the new downward structure, which is why there are 1,000 reasons to be selling right here. Now, stop hunt. I've heard people talking about like stop hunts and stop raids and what. This is a point of manipulation in price, whereby market makers are influencing you and I to be taking buying positions. Buy stops are being triggered, stop losses are being taken. This is what is referred to in the market as the stop hunt, right? The stop hunt in the market. I'm not going to talk about stop hunt because this is not like the purpose of this call out. This is what we refer to as the stop hunt, whereby price is going to manipulate traders to go to the wrong direction. It's going to trigger buy stops, a whole lot of confusions. And this is where most of accounts blow. And this is where wrong positions are built, buy side positions are built, because if you look at how powerful and how strong these upward candles are, you would not anticipate that they will suddenly shift. Now, if you look at these two concepts, you will not see them on this M right here. On this M right here, you will not see breaker. So ultimately, you will not see the origin. So this is why this was just a simple retracement, and this is why this is actually a reversal sign. Rewatch this video while it's still available on YouTube. I'm not going to remove it personally, but I know it's going to be charged. Now, when that happens, we start building selling positions, right? There are many situations whereby this happens. There are many scenarios when this happens. If I look at the volatilities, which are my personal favorites, actually, if I look at this cycle of the breaker right here, if I look at this cycle of the breaker, and I have my M right here, which actually, I have my W in this case, which actually followed. This specific zone was actually the source, and I have what I refer to as the stop hunt, exactly how it happened initially. Let me look for another setup of the same scenario. Another setup of the same scenario. I have this upward structure. I have this candle right here, which actually participated as the breaker, right? And if you look at this M, this is why it was successful. Why? Because this upside zone right here is the source, right? And when price came back to retest the source, I was looking for opportunity to be in a sell. And if life allows me, I'm going to host another meeting showing you guys how to take an opportunity to buy and to take an opportunity to sell. I'm talking about 3 things: entry, stop loss, and take profit, right? Now, this is a perfect confirmed switch of trend, right? This is not a perfectly confirmed switch of trend. Why? Because there is no breaker source setup, and there is no breaker source setup, and here there is breaker source setup. Here there is breaker source setup. But if it's an M or a W, like for example, in this case, right, I've spotted one. We have a drop, we have a breaker source setup right here. I know there were many buy orders right here because of lack of specific small little detail of just a breaker, which is why you had to take a loss for a specific entry. I'm sure this information that I'm giving you guys is a little bit or a lot more helpful is not for you to change your methods of trading or for you to change your methodology or your strategy of looking into things, but it's for you, it's to help you to look at the other side of market maker view, right? The other side of the so-called ICT, or the other side of the nice pips strategy, right? This is how I personally look at things. You ask the students who actually participated in my mentorship, students who actually participated in the 15 days, they'll tell you that these are some of the things that I look at when I'm looking at trading. It doesn't matter which time frame, it doesn't matter which asset, this always holds according to me, right? This is something that I learned from various sources, paid platforms, free platforms, and personal research. I'm going to quickly go through a couple of questions that I can answer. Before I end the meeting. So question number 1 came from Bright. It says, to identify FVG, it is only 3 candles in a moment, or it can be any candle in momentum. To identify fair value gaps, we consider 3 candles, the middle candle being the reference point exactly, right? To identify fair value gaps. Like for example, we have this, we have candle to the left, candle to the right, like this right here. We have candle to the left, right here, candle to the right, right here, and we have that fair value gap being taken out before price traded to the upside. The same applied right here. We have this, and we had that fair value gap being taken out before price trade to the upside. The same applies right here and right here. We have that fair value gap being taken out before price trade to the upside. You can do this the whole day, I'm telling you. You can do this the whole day, just as a matter of your personal practice, adding on to your personal knowledge. That's for you. It's very important for you. Now, the question number 2 came from a Delson Zita, which says, which is the best time frame to do these gaps in volatility indices? These gaps, you can apply them on any time frame depending on what type of a trader you are. One day I'm going to give you a psychology class so that you can choose whether you want to be a scalper, whether you want to be a day trader, position holder, or what. But time frames only depends on what type of a trader you are. It's a personal decision that I cannot choose for you. Then I have a question, I don't know, from Terence Dick, which says, show us some indicators for VIX. I'm not trading indicators at the moment. This is not the use of this call. I called for this so that I know not to show you indicators or anything that you don't want to know about. Then I have Kabir Adam. I want to know how you make analysis to retake failed signals. I'll make you know. Then I have another question from 14. Which is the best time frame to identify the breaker candle? That's for like higher time frames, right? Because obviously you want to go lower and lower and lower so that you can grab an entry. This breaker and source setups are for you to identify a shift in trend or the continuation in trend. So obviously you want to do this on a higher time frame so that when you drop lower, you are only looking for opportunity. I'm talking about entry, I'm talking about take profit, and I'm talking about risk, which happens to be a stop loss in this case. I don't know if we have any questions in the chat. If we don't have any questions, I'm sure this meeting was some kind of like helpful to you, to help you identify or to help you know some of the things that you wish you knew, or some of the things that you may always wanted to know. If it was of any help, please drop a like, subscribe to the YouTube channel, and comment. I actually make time to go through all the comments, and they're actually helpful to me to know your feedback from you guys, to know what you guys think about my services, my teachings, and my media. Obviously, I'm talking about video, audio encoding, and all that stuff. With all that said, I'm going to close the meeting and I'm going to end it right here. This is your Luis from NicePip speaking. I'm going to end it. And if you participated, if you attended in this, you are 100% welcome and congratulations to you for the new knowledge. If it's old to you, if it's useful to you, I hope you make sure you use such opportunities. And I'm out, guys. Peace.